Retirees across the United States need to stay alert because a type of banking behavior that often seems routine, harmless, and completely ordinary can turn into a major tax problem with penalties that can climb to $10,000 or even far beyond that. This is where the situation gets serious. The risk is not based on gossip, panic, or speculation, but on the way federal tax rules connect directly to everyday financial activity, especially for older Americans collecting Social Security, pensions, retirement account distributions, and in some cases, stimulus-related credits or other government benefits. What most people miss is that current enforcement patterns and continuing federal reporting requirements mean some transactions, when misunderstood, misclassified, or handled the wrong way, can immediately attract attention. Here's the core issue. Certain bank activity can create problems, it can tie directly into IRS reporting rules, it can affect retirees receiving Social Security income, pension payments, or other benefits, and it can expose older adults to avoidable penalties unless they take steps to protect themselves. Many retirees assume that once full-time work ends, taxes become simple and mostly automatic. They often believe that if their money comes mainly from Social Security and maybe a modest pension or retirement account, the chance of facing a major IRS penalty is extremely low. But the reality is more complicated, and retirement can introduce a different layer of tax complexity instead of removing it. Income may arrive from several different places at once, including Social Security retirement benefits, supplemental security income for those who qualify, withdrawals from traditional IRAs or 401k plans, survivor benefits, annuities, part-time consulting, rental income, or even occasional sales of assets. Every one of those income sources interacts with federal tax law in its own specific way. At the same time, banks are required to report certain transactions to federal authorities, and when that information does not line up with what appears on a tax return, those reports can trigger audits, notices, and penalties. One of the biggest areas of confusion involves cash transactions and structured deposits. Under federal banking law, financial institutions have to report cash transactions above certain thresholds. When a retiree places large amounts of cash into a bank account, especially on a repeated basis, that pattern can be flagged for reporting. That does not automatically mean anything illegal has happened, and that point matters. But now, watch this. If those deposits do not match the income reported on the retiree's tax return, or if they seem to be deliberately split into smaller pieces to stay below reporting thresholds, the scrutiny can become serious very quickly. The penalties connected to improper reporting, or what authorities view as structuring, can be severe, and in some cases, civil penalties can reach $10,000 or more for each violation. Many seniors do not realize that even completely innocent conduct can still look suspicious to automated monitoring systems. A retiree might sell a car for cash, get repaid in cash for a personal loan, or pull money out from a safe kept at home, then decide to deposit those funds little by little. If those deposits show up repeatedly in amounts just under federal reporting thresholds, the pattern itself may trigger a report. That does not mean the retiree intended to do anything wrong. However, if the IRS later concludes that those deposits actually represent taxable income that was never reported, penalties can follow. Those penalties may include accuracy-related penalties, failure to file penalties, failure to pay penalties, and in more serious circumstances, penalties tied to willful violations of reporting rules. That is only one part of the picture. Retirees also need to understand the reporting rules attached to retirement accounts. Once a person reaches the required age for mandatory withdrawals, called required minimum distributions, failing to take out the correct amount can create a substantial penalty. Recent law changes reduce some penalty percentages for missed required minimum distributions, but the financial hit can still be significant if the mistake is not corrected fast. If a retiree does not withdraw the proper amount or fails to report it correctly, and the IRS spots the mismatch through information sent by financial institutions, extra taxes and additional penalties can follow. In some cases, the way the penalty is calculated can push the total into the thousands, and when that is combined with other reporting problems, the full liability can rise above $10,000. Another major area of exposure involves third-party payment platforms and electronic bank transfers. A growing number of retirees use digital payment services to receive money from relatives, sell small personal items online, or handle side activities that seem minor and informal. But federal reporting rules have expanded in recent years, and that means some platforms may issue tax forms once transactions pass certain thresholds. If a retiree receives money through these systems and those funds are not properly categorized or properly reported, the IRS may view them as taxable income. If the dollar amounts are large enough and the tax return offers no explanation, penalties can be assessed. For seniors living on fixed incomes, even a few $1,000s of surprise tax liability can be financially crushing. Retirees receiving Social Security benefits also need to understand a point that is often misunderstood. While some Social Security income may be tax-free, that income can become taxable depending on total combined income. Combined income includes adjusted gross income, non-taxable interest, and half of Social Security benefits. If bank deposits suggest that actual income is higher than what appears on the return, the IRS may recalculate how much of the Social Security benefit is taxable. That recalculation can raise the overall tax bill and may also lead to penalties if the agency finds an underpayment. Seniors who assume Social Security is always completely tax-free can be blindsided when bank activity suggests a different income picture. There is also increased focus on foreign accounts and international transfers. Some retirees keep money in accounts outside the country, receive pension income from another nation, or move funds internationally on a regular basis. U.S. citizens and residents are subject to reporting requirements for foreign financial accounts once those accounts exceed certain thresholds. Failing to report those accounts correctly can lead to extremely large penalties, including penalties that can easily go beyond $10,000. Even when the failure to file required information forms is unintentional, the fines can still be significant. Retirees who split their time between the United States and another country need to be especially cautious because international banking activity is closely monitored under federal law. Stimulus payments and other federal benefit programs also intersect with tax reporting in ways many people underestimate. Federal authorities have issued economic impact payments and tax credits intended to help households, and in some cases, individuals who did not receive the correct amount claimed credits on their tax returns. If bank records show that payments were actually received, but the tax return does not reflect that correctly, or if duplicate claims were made, the IRS may send notices demanding repayment, along with penalties. Retirees who switched bank accounts, moved to a new residence, or used joint accounts during the periods when stimulus money was distributed may run into reconciliation problems if their records are incomplete. Another source of trouble involves early withdrawals from retirement accounts. While many retirees are older than the age that typically triggers early withdrawal penalties, some can still face penalties if they access certain accounts the wrong way. On top of that, incorrect rollovers or transfers between retirement accounts can accidentally create taxable events. If money is withdrawn and not redeposited within the allowed time frame, that money may become taxable income. And if that taxable income is not properly reported and enough tax is not withheld, underpayment penalties can begin to build. Add interest charges on top of that, and the total can grow fast. The federal tax system is built heavily around information matching, and that detail is crucial. Banks, brokerage firms, pension administrators, and payment platforms send forms directly to the IRS showing interest income, dividend income, retirement distributions, and certain categories of transactions. When a retiree files a return, the IRS compares the numbers on that return to the records it already received. If something does not match, automated notices are generated. Many seniors are shocked when letters arrive claiming income was not reported. Those notices often include proposed tax increases and penalties. If the retiree does not answer quickly or cannot provide supporting documentation, the proposed assessment may become final. Here's the twist. Penalties do not require criminal intent. Civil penalties can be imposed for negligence, for substantial understatement of income, or for failure to submit required forms. For example, if a retiree underreports income by a large enough percentage, an accuracy-related penalty may apply. That penalty is commonly calculated as a percentage of the tax that was underpaid. When the underlying amounts are large, the resulting penalty can reach $10,000 or more. That is exactly why detailed record keeping and complete disclosure matter so much. Retirees living on fixed incomes also need to watch estimated tax requirements. If money coming from pensions, part-time work, or retirement account distributions does not have enough withholding taken out, the IRS may require quarterly estimated tax payments. Failing to pay enough during the year can trigger underpayment penalties. At first, those penalties may seem minor, but they can pile up over time, especially when combined with other reporting mistakes. Seniors moving from a paycheck world where taxes were automatically withheld into retirement income streams that may not have withholding often miss this requirement entirely. Bank activity indicating higher income than the return shows can also affect eligibility for certain benefits. For instance, eligibility for supplemental security income depends on income and resource limits. Regular Social Security retirement benefits are not means-tested in the same way, but some state-level assistance programs do look at total financial resources. Large unexplained deposits can trigger reviews. If authorities decide benefits were paid incorrectly because income reporting was inaccurate, repayment demands may follow. That is separate from IRS penalties, but it can intensify the financial pressure and make an already difficult problem much worse. Scams and fraud add another layer of danger. Some retirees become targets of schemes involving transferred money, incoming funds that must supposedly be sent back, or transactions that later appear irregular or suspicious. If large amounts of money move through a retiree's accounts, the bank may report unusual activity. And if the retiree cannot clearly document where the funds came from and why they moved, the IRS may begin asking whether the money was properly reported as income. Victims of fraud are not automatically responsible for taxes on funds that were stolen, but untangling those situations can be difficult, stressful, and time-consuming. The bigger lesson is simple but urgent. Retirees need to treat banking activity with the same level of seriousness that wage earners give to their paychecks and tax withholding. Every deposit, every withdrawal, every transfer, and every retirement distribution can carry tax consequences. The safest approach is organized documentation, a clear understanding of reporting rules, and tax returns that accurately show every source of income. A $10,000 penalty usually does not come from one tiny isolated mistake. More often, it grows out of compounded errors, large mismatches, repeated discrepancies, or a failure to respond to official notices on time. That is why what looks like harmless routine banking can become such a high-stakes issue in retirement. And what makes this especially important is that the warning signs are often easy to miss. A retiree may believe a gradual series of cash deposits is simply a practical way to handle money from a home safe, a personal repayment, or a private sale, yet the pattern can still look questionable when viewed through federal reporting systems. A retiree may assume a digital payment from family, an online sale, or side income is too small or too informal to matter, only to discover later that a third-party platform has already issued information that the IRS now expects to see reflected somewhere on a return. A retiree may think that because income is coming from pensions and Social Security instead of wages, the reporting burden is lighter, when in reality, the reporting structure has only changed shape. The forms may come from different sources, but they still reach the IRS, and the matching process still happens. What most people miss is that the federal system does not depend on a retiree's intention when it first flags a discrepancy. It depends on records, forms, thresholds, deposit patterns, account activity, and whether the return matches the information already in federal databases. That is why even honest mistakes can become expensive. It is also why older adults who have several overlapping income streams need to be especially careful. Social Security retirement benefits, supplemental security income for those who qualify, annuities, survivor benefits, IRA withdrawals, 401k, distributions, rental receipts, consulting payments, interest income, dividends, online sales proceeds, foreign pension transfers, and occasional asset sales can all create a financial picture that is more layered than it appears at first glance. If one part of that picture is missing from the return, incorrectly categorized, or delayed, the mismatch can ripple outward. A deposit may suggest income that is not shown. A platform form may indicate payments that are never explained. A retirement distribution may be visible to the IRS, even when the taxpayer forgets it. A foreign account may exist above reporting thresholds, even if the retiree believes it is irrelevant because the money is overseas. The risk becomes even larger when several small issues happen at once. A missed required minimum distribution, an underreported payment platform amount, a series of structured-looking cash deposits, and insufficient withholding on retirement income may all appear unrelated to the retiree, but together they can create a much larger problem. Penalties can stack, interest can continue building, automated notices can escalate, and what started as confusion can turn into a liability that exceeds $10,000. Now watch this closely. Many of these situations begin with ordinary behavior that does not feel like tax behavior at all. Depositing cash does not feel like filing a return. Moving money between accounts does not feel like generating taxable income. Receiving funds through a digital app from a family member does not feel like entering a federal reporting system. But under existing rules, all of those activities can intersect with tax enforcement, especially when amounts, timing, patterns, or documentation create uncertainty. That is why the danger is not limited to wrongdoing. The danger also includes misunderstanding. And misunderstanding is exactly what puts many retirees at risk, because retirement often changes the source of income without changing the government's expectation that everything be reported correctly. Seniors who once relied on automatic payroll withholding may enter retirement assuming the tax system will continue taking care of itself. Yet pensions may not withhold enough. Distributions may arrive without proper planning, and side income may come in without any withholding at all. Quarterly estimated payments may suddenly matter. Benefit eligibility reviews may suddenly matter. Foreign account disclosure may suddenly matter. Reconciliation of stimulus-related credits may suddenly matter. And when the paperwork does not line up, the system responds. That response can include notices, recalculations, repayment demands, proposed assessments, added tax, and penalties that quickly become overwhelming for households living on fixed incomes. The most important takeaway is not panic, it is precision. Retirees do not need to fear every transaction, but they do need to understand that every transaction leaves a record, and those records can be compared against tax filings and benefit claims. Clear records, accurate returns, complete disclosure, timely responses to notices, and careful handling of deposits, transfers, distributions, and foreign accounts are what reduce the risk. Because in the end, the threat is not some mysterious hidden trap. It is the very real connection between ordinary banking activity and federal reporting systems that are designed to detect inconsistencies. And once those inconsistencies appear, the consequences can be expensive, stressful, and very hard to unwind, especially when the combined impact of penalties, added taxes, repayment demands, and interest turns what seemed like normal financial behavior into a liability that reaches $10,000 or more.